Let's take a few minutes and talk about total enterprise value, which is also sometimes referred to as enterprise value. This is in a document that I'm sending out to you. You'll see this same material there. But let me discuss it briefly for you. Let's start with a very simple example. It'll make this, I think, more intuitive. Let's say that you bought a car for $10,000. Now this is a little bit of a special car because it has some cash in the glove box. It actually has an envelope with $3,000 of cash in the glove box. In addition, you assumed a loan that you now have to pay that was on the car of $5,000. So if someone asks you, what did you really pay for the car? It's not quite as simple as saying, I paid $5,000 because you got some cash and you also got some debt. So what did you pay for the car? So let's go through this simple example shown here in the middle of the page. You paid $10,000 and you got cash, $3,000. So if you say net of cash, what did I pay for the car? I paid 10 minus 3, $7,000. However, you also assumed an obligation of debt of $5,000. So if you take what you paid after cash of $7,000 plus the debt that you assumed of $5,000, the car cost you $12,000. Now the reason we go through this somewhat contorted example is when you buy a share of Microsoft, you just don't get the Microsoft business. You also get cash on their balance sheet and you also get any debt that they may have. I can't just go to the marketplace and say I want to buy a share of Microsoft, the business, and not get their cash and not get their debt because I don't want to do the arithmetic. The fact is you get everything that the company owns. So if this were a company, and let's say that these were billions of dollars, if the market value of equity, and this is shown at the bottom of the screen here, if the market value of equity was $10 billion, and the way you get the number for market value of equity is the number of shares out times the share price, so it could be billion shares out times $10 a share, for example. And then you look at how much cash and how much debt the company has. So let's say that the company has $3 billion in cash and $5 billion in debt. So that would say that the business itself, just like the example above with the car, is being valued at $12 billion, doing the same arithmetic as shown above. So what is this enterprise value? Well, it's the value of the operating business, excluding how it's financed. If you said, all I want to do is buy the business, this is what it would cost you. Then you can decide how much debt or how much cash you need to have in addition. Debt being less expensive than equity, you could use debt to reduce the amount of cost cash that you use to pay for the company with. Or you might say this is a volatile industry, this is a difficult industry, and I need to have a cash reserve in case something goes wrong. Otherwise, I will perhaps go bankrupt, and you don't want that. So this is a simple concept, and it's easily applied to companies in the public markets. So let's jump to the next page here. You can use the formula for this rather than the simple example above. This says enterprise value, also named total enterprise value. Those two names are used interchangeably, is equal to the market value of equity, number of shares times the share price, and then adjust it for cash and debt. So if there's debt, you would add that, and if there was cash, you would subtract that. So let's take a simple example here of two companies that are virtually identical, very similar characteristics anyway, and look at one that has net debt, more debt than cash, and the other one that has net cash. So in the left column here, we have a company that has a value of $100 million. It's got debt of $40 million. So what should the common stock trade in the marketplace? Now, what's shown here is net debt. It could be that it has a bigger amount of debt and has some cash, but when you net the two together, you get 40. So let's go through the example on the left side. The company's value of $100 million is equal to the value of the debt plus the value of the common stock. Like, who owns this company? It's worth $100 million. Well, Well, 40 million of it is owed to some debt holder. It could be a bank, it could be bondholders, and 60 million of it is owned by the shareholders. That's how it's divided up. So if there were 10 million shares outstanding, jumping to the lower part of the screen here with the on the left column, you would have a share price of $6 a share. That's how you would calculate a share price target, given an assumption I have determined, however you decide to do that. It could be a multiple of cash flow, a multiple of earnings, multiple of many other things. I've decided this company is worth $100 million. What should the stock be trading at? That's the approach you would go through. On the right column, we have an example of a company with net cash. So here the company has a value, again, of $100 million, and the company has $40 million in cash. It may have some debt, but it also has additional cash. So it could have $140 million of cash, and it could have $100 million of debt, and you simply net the two together. That's how the net cash is determined. So in this case, the fair market value for the common stock, all the stock out there, would be the value of the company plus the value of the cash. Right? You're adding up all the assets. So it would be $140 million. And if in this case as well, there are 10 million shares outstanding, you would have a stock price of $14. And the company value is the number that's known as enterprise value or total enterprise value. So let's move to another page here, another a little bit farther down on that page. If you have a stock share price and you want to determine what the enterprise value is, you start with that share price and say, I have $14 a share, I have 10 million shares out, therefore the market value of equity is $140 million, and of that, $40 million is cash. The rest of it is the company. The rest of it then is the enterprise value, and the enterprise value is $100 million. So this is a method for, given a share price and given a cash balance or a debt balance, that you can determine what the business itself is being valued at. So enterprise value is often a better approach than using, say, price to earnings, which is the most common, I think, way people value stocks, because the value of a company will differ depending on how much cash or debt it has, because of the methodology that we went through here. Let's go down to the next section here and say, what if the company became 10% more valuable? Something happened, they have a new product, the industry changed, the growth outlook changed. Let's put that aside, but just say something changed and the company is now 10% more valuable. So you'd expect that the stock price would improve, and it does, but how much? The first thought would be it's going to go up 10%, but let's work through it and see what actually happens. So let's look at the company that has net debt first, and I'm going to highlight this here. Here's what the company value was: 100, now it's worth 110. It still has a net debt of 40, and that means that the value attributable to the common stock is 70. Just taking the value of the whole package, attributing part of it to debt, part of it to shareholders. So if the value of the common stock is now 70, it was 60, if we do the math and say how much has the share price gone up, it's gone up 17%. It didn't go up 10%. And the reason it didn't is because it has leverage. It has net debt. Now what about the case where the company has net cash? Company value increases 10%. It's got net cash. The total value of the common stock now is 150. And that's up from 140. And in this case, the value of the business increased 10%, but the share price only increased 7%. And the difference is, the reason that that change isn't 10% is the cash portion didn't become more valuable. This $40 million piece is still worth $40 million, even though the business itself increased by 10%. So you can see there's an advantage of having net debt you get a higher increase in value, all things being equal. The thing is, you do bring up risk. If the value of the company had decreased by 10%, you would have a similar magnitude of decline. It works both ways. This is just an explanation of what I've spoken about here. Having leverage is not magic. It simply increases the volatility of the share price. So I hope that's been helpful, and I look forward to the discussion online.